I tell you who doesn't know about it. This 2-week-old baby boy. He has no idea what his daddy has done for him. And yet he has now massively changed the trajectory of his entire life. So let me ask you a question, especially my parents and grandparents. What kind of financial environment are we building for our children?
Welcome to the Bankless by Design podcast, where we rethink money, ditch the system, and rediscover what it means to truly thrive well. I'm Tricia Miller, mom of 7, financial coach, and founder of ThriveWell. Around here, we believe wealth is more than numbers. It's about freedom, stewardship, and building a legacy that lasts. If you're ready to challenge the norm and take back control of your financial life, you're in the right place.
Hello and welcome to the Bankless by Design podcast. My name is Tricia Miller. I'm your host today, and I want to address a question. Why in the world would anyone put a whole life insurance contract on a baby? Well, I was thinking about this topic this last week as I was working on an application for a client's brand new baby boy that was just born this last month. So let's talk about it. Because when we talk about life insurance, we're usually thinking about death. And death and babies, well, they just don't go together for good reason. God forbid, we don't want anything to happen to our little ones. But that is not the point or the heart behind this idea when a parent or grandparent is putting whole life insurance on a child. The focus is not on the child dying. The focus is actually on the child living. The problem is most of us aren't taught there are these fantastic living benefits to life insurance. So we're going to dive into all of that. But there is one major consideration that I want to talk about right up front, and that is insurability. Most people will assume that their children will always be able to get life insurance later on down the road, maybe when they have kids or they have a quote-unquote reason to get insurance. So we just assume that they're healthy now. Surely when they grow up, they'll be able to apply and get approved. But it's not always the case. Life insurance is medically and financially underwritten, and children as well as adults can come down with conditions that make them uninsurable. I have dealt with this myself. My own daughter was diagnosed with cancer at the young age of 19, and I can promise you we never saw that coming. We did not have a history of cancer in our family at all. And yet, here she was, with a diagnosis, undergoing surgery and chemotherapy. Fortunately, she's been cancer-free now for more than 10 years, but it's the only reason that she was able to be considered for life insurance again. And I am very grateful that she's cancer-free. But what if that had not been the result? Nelson Nash talks about this in Becoming Your Own Banker, when his own grandchild, who came down with a form of brain cancer at a mere 6 weeks old. Who would have thought that? And yet it happens. So here's the thing. When you put a policy on a child while they're young and healthy, you are securing something very valuable for them. You're doing something for them that they can't do for themselves. So if later on down the road, the child develops something like cancer or perhaps diabetes or a heart problem or anything else that could affect underwriting severely, that policy is already in place and it can't be taken away from them. But there's another very good reason to put whole life insurance on a child, and that is to capitalize that child's life. Now, maybe you've never heard that phrase before or heard it expressed like that, but think about it this way. This baby has an entire lifetime ahead of him. Think about all of the things this child is going to need in his life, all of the opportunities that may come along, all of the expenses, all of it. It all comes with a pretty hefty price tag. There's going to be everything from bicycles and braces to cars and college to weddings to homes, you name it. This child is going to have expenses in front of him, and he's going to have a lot of money flowing through his life, no matter what. The question is, which direction is that money going to flow? And who's going to control the banking function of that money? Is it always going to be to a third-party bank? Will a credit card be the go-to where outside institutions capture all the interest, control the terms of loans, and make profits off of this child's financial needs? Or is it possible that a family could think differently and begin building a system early? This is really what we're talking about. Now, a dividend-paying whole life policy is a private contract, and it comes with guaranteed cash value. it provides a death benefit, and it gives the policy owner the contractual right to access capital through policy loans on demand. There's no asking permission here. And ultimately, it's an appreciating cash flowing asset. We don't think of it that way. It's intangible to us, so it gets missed. When it's designed properly and it's used wisely, it can become a private banking system that will benefit not only this child, but the whole family line. So my client in particular is applying for a policy on his infant son where he will be paying a $10,000 annual premium. And this particular policy is designed to pay to age 95. So let me pause right there because all of that might have just taken your breath away. That's a pretty healthy premium for a baby. Most families are probably not going to start there. Some might start with half of that or even less, and that's okay. So do not hear this as everybody should run out and put a $10,000 a year policy on a baby. That's not at all what I'm saying. But for this particular family, it made complete sense. The father is a real estate investor and a savvy businessman. He understands the value of capital and especially having unmitigated access to that capital in a place where he can store his wealth and it will continue to compound. He's building a pool of capital that he's going to use to fund his own investments, to buy more real estate or new businesses. That's what he's already been doing with the policy that he owns on himself and his older children. Since this infant has older siblings, it's worth mentioning that when you insure children, the insurance company wants to see all of the children in the family treated equally. Now, the parents do need to be insured first. The amount of death benefit that you can place on a child is directly proportional to what the parents have in coverage. So that's important too. So this isn't a strategy where we're going to ignore mom and dad and just go insure babies. The parents must be covered first. Now, as I was working on this illustration, I couldn't help but be pretty impressed by the possibilities that this single policy could create for this family. Quite frankly, we often don't get a sneak peek into just how powerful dividend-paying whole life insurance can be over the course of a lifetime. So here we have this baby boy getting this policy very young, and we get to see how this policy works over a long period of time. So I am going to share with you some of the numbers. Just keep in mind that there's no way that the numbers alone will tell the whole story. We can only use our imaginations for this little boy. And that's what we're going to try to do. But before we get into it, I am using the current non-guaranteed side of the illustration, which includes dividends that are not guaranteed. Now, this company has paid dividends consistently every single year without fail for more than 120 years. That means it has done so through wars, through pandemics, through the Great Depression, and every other downturn the market has had. So it does give us a good deal of confidence as we move forward. But again, the dividends are not guaranteed. But an increase in the cash value is guaranteed. The cash values inside the policy must rise to meet the death benefit by age 121. And that's by contract. And therefore, it can't go backwards. So to be clear, this is not about chasing a high rate of return. That is not the purpose of the infinite banking concept. The purpose is that access, those guarantees, and the control that creating our own system for financing for everything that we need in life can give to us. And eventually, we can become completely independent of the need of any third-party bank in our lives. So let's go ahead and take a look at some of the numbers. We can see here on the top line that in year one, this dad is paying a $10,000 premium, and his son is covered by a $400,000 death benefit as soon as that premium is paid. And by the end of year one, almost $6,000 would then be available to dad should he need to access some of his capital. It's not huge, but it's not nothing either. And when we consider that he has paid $10,000, but he can access approximately $5,600 of it, then we realize that the initial sunk cost of starting this powerful growth engine is really only a little bit more than $4,000 in year one. And that is the worst that it will ever be. Now, when you see what this creates, you'll realize that that is a very small cost, if you can even call it a cost by the time we're done. So we're going to move forward here a little bit and let Dad keep paying his $10,000 premium every year. He gains more access to that capital. But if he continues to capitalize it and use it to do his investments, that's fine. If he doesn't, that's okay too. Just simply getting in the habit of setting money aside in a place that is safe and growing is a beautiful thing. But Dad does have the contractual right if he wants to borrow against these cash values and use them to make more money. That's not saying that he can't also use them for his child. So he can be covering some of his expenses with it if he wants to. And I think one of the most beautiful things about it is that it can become a teaching tool. So let's just say that by the time our little guy is 8 or 10 years old and he wants a dirt bike or something that a little 8-year-old boy might want, this will provide him with a great opportunity for Dad to introduce this concept to him. And it's really quite simple. All Dad has to do is teach him that we're going to borrow money from the family bank. And he'll also tell him that the rule is that we can borrow from the family bank to make this purchase, but now you have to find a way to earn the money to pay it back with interest. And of course, Dad can help him find age-appropriate odd jobs to do around the house, or perhaps he's old enough to actually mow lawns or something to earn the money to pay it back. But he should especially teach him that the family's capital is to be valued higher than any other capital. It was hard-earned with precious time and skill, so we want to pay it back with extra interest. It's good to think of this as the family's Tier 1 capital. When we pay the bank back with interest, we are valuing their money. We need to value ours even more. So this is the lesson that he needs to learn. But here's the other thing that he will find out. We can teach him that when we pay our own system back, those dollars are replenished to use again. But here's the almost magical thing that can happen. And you could use a mason jar and some Monopoly money to demonstrate this to a child, perhaps. But as he pays it back with interest, that increases the value of the money that's in the jar. But extra money is also being produced inside that jar by the policy itself. So every time we pay it back and we look back in that jar, there's more money than we anticipated to be used again the next time. How cool is that? So he won't be just getting a new dirt bike or whatever it is that he wanted. He will also be getting a great financial education. And by teaching this little guy early, he's going to grow up with a very different mindset about money. It'll be on a completely different level where he learns that money does not always have to flow away from the family. And all debt is not bad when you own and control it. What a different kind of experience that will be, rather than where we look in our bucket and we see more there than it was the last time. Typically, we find less. In fact, we have leaky buckets most of the time where we can't seem to keep anything in them. All right, this is how you raise a child to think differently about money. Meanwhile, year after year, the pool of capital keeps growing. So by the time our little boy reaches 16 to 20, those famous years that are often the priciest for parents, every single time Dad is making that $10,000 premium payment, his cash values are now doubling inside the policy. Look at year 18, he puts in $10,000, and by the end of the year, it has increased the cash values to $21,000. Now, I don't know about you, but I think at this particular time in life when a parent is paying college tuition, that might be a really good time for our dollars to start doubling. But maybe we're not at college yet. Let's just think about the 16-year-old boy who wants to buy his first car. Well, he's already well on his way to learning how the family banking system works at this point. He's got a good sense of the expectations and the rules that govern the system, so he'll have the advantage of having access to capital to make that purchase. He'll be able to purchase a decent vehicle, and he'll have the flexibility of setting the terms with his dad to pay it back. Now, wisdom needs to be exercised here, no doubt about it. But when it's used wisely and the terms and the expectations are clear, it can work out very well. I have done this multiple times with my own children. They know the rules, they understand the terms, and they have their own motivation to make sure that they make the payment. They know that one day they will be the beneficiaries, and anything that they have contributed by way of interest will come back to them multiplied many times over. So again, this is your private system. You own the gold, you make the rules, but do so with love, care, and wisdom. When this child is 18 years old, our young man is going to have some options. There is $251,000 of cash value in his policy at this point. Now, dad can be borrowing against these cash values to pay for college, to set him up in business, or send him to trade school. It's only limited by your imagination. His options are endless, really. But contrast this for a minute with something like a 529 plan that's designed specifically for education with lots of rules and restrictions. That's because it's a tax-qualified plan, so it comes with those rules. And it's usually tied to the market, which also adds risk and volatility to those dollars. There is none of that in whole life. So if our baby boy does not end up going to college, or even if he does, but he gets a scholarship or decides that he'd rather start a business like his father, he can do any of those things and still have access to the capital to fund it without any penalties. And that's important because none of us knows exactly what our children are going to need 10, 15, and 20 years from now. This is a private contract. His dad is in control. He's got guaranteed access to the capital on demand. Let's fast forward a few more years, and our baby boy is now a 30-year-old man. He's likely at the age where he's starting his own family and probably needs to buy a home. Could the policy possibly fund that? Well, at 30 years, we see that we have $600,000 in cash value. So more than likely, yes. At the very least, he can make a significant down payment on a home. And I say down payment because I'm adjusting for inflation, and who knows where that will be at in the future. This young man should set up an amortization schedule, just like the one that he would have received from the mortgage lender, and make principal and interest payments back to the family's private banking system. How would you like to make that payment back to yourself? Think about that. Instead of some big corporate bank out there getting all that interest, because it's significant, that is now coming back to the family as more capital that can be accessed and used again. It could also fund more policies for the grandchildren, if you can imagine that. At this point, our dad has paid $300,000 of premium into this policy. He's been able to access this capital all along for his son's needs, as well as for his own investments and his businesses. And maybe this is a good place to remind you that none of these stories show up on this illustration. How much money has Dad been able to generate in investments using this capital? How many emergencies have been handled, opportunities taken? I can't stress this enough. We have no idea. But the entire time, these dollars can be continuously used and reused, recycled. It is the velocity of money in motion. To think that it's just $600,000 in cash value is actually a narrow view. There is more happening in real life than these numbers will ever show on the page, even as impressive as this illustration might be. I just want to pause here for a moment to consider the options that this dad has, because I know as some people see this illustration and they see that it's payable for 95 years, that thought can be overwhelming. And indeed, recently I heard this very same concern. I have to pay that premium for how long, and what happens when I don't live that long, and just all kinds of questions. So I want to remind you that the dad is the owner and the payer of the policy, and that means that he has control. And one of the things that he can do as the owner is he can transfer ownership. If he wanted, then he could borrow against the cash values to recoup everything that he's ever paid into this policy by way of premium, and then he could transfer the ownership of the policy to his son with an outstanding loan, or he could transfer it to him without an outstanding loan. Either way, it's his choice. He's the owner. And either way, he is effectively handing his son a cash-flowing asset that will continue to grow and give his son a place to warehouse his own wealth. Or if he wanted to keep the policy, but he didn't want to pay premium anymore, could he stop? Well, yes, actually he could. He could change the dividend election such that the dividend is set to pay the premiums. The dividends have now exceeded how much the premium is. It would slow down the growth because every time a dividend is paid, it purchases more death benefit and acts as gasoline on this fire. It would not want to slow that down. if I could help it. He also could borrow against the cash values to pay the premium if he wanted to. And he could just retain his ownership and keep paying the premium and enjoy the benefits of this exponential curve that is being created until he passes away. He could just make his son the contingent owner, meaning that upon his death, his son would receive ownership. He has lots of options. Now, for our purposes today, let's just say that Dad decided to transfer ownership and the son is now paying the premium. I have it on good authority that this is what Nelson Nash did. And I remember hearing Nelson say, "Good God, you can't take it with you." So in other words, you might as well give it away. So a few years later, if we look down this illustration, you're going to realize that something changes in year 38. You can no longer pay a $10,000 premium. The policy will now only allow him to pay the base premium of $5,000 until age 95. But look at what is happening here. In year 38, that $5,000 premium is causing a $51,000 increase in cash values that year alone. Now, do you seriously think our son here who's paying this premium is saying to himself, "I wish I could get rid of this $5,000 premium"? No, he's actually saying the exact opposite. If $5,000 in premium is generating $51,000 of cash value, dear God, I wish I could pay more premium. And yet, at the moment that I told you in the beginning that this was a pay to 95 policy, I'll bet you thought, dang, you have to pay that premium for how long? Well, yes, you do. And boy, do you want to. Here's where Nelson's rules come to mind. He says, think long range. Don't be afraid to capitalize. It's more premium, not less, for as long as possible. The premium is the solution. And here is where we see the incredible power of dividend paying whole life. It doesn't happen overnight. It's not get rich quick. This dad had to pay $10,000 a year for a long time, but it is very powerful over a lifetime. The water has now reached the boiling point. It is turning into live steam, and live steam has incredible power. And our baby boy, who is now a grown adult, is looking at a very reliable passive income stream. He doesn't have to wonder in his passive income years if it's going to run out, because it won't. At age 65, he could take $150,000 every year for the rest of his life, starting out as withdrawals up to his cost basis and finishing with loans and allowing the interest to accrue. And still the policy would not lapse. If our baby boy, now an old man, passed away at age 90, he would have taken $3,750,000 in passive income and still leave a $4.2 million death benefit to his heirs, tax-free. And the only amount of premium ever put into this policy was no more than $660,000 for the entire time. Now shut the front door. This is insane, but this is the magnificent power of dividend-paying whole life. And it is time we open our eyes and see the truth of it. A father starts a policy on his baby. It cost him a loss of liquidity of $10,000 over the first 5 years. That's it. That was his sunk cost, if you want to call it that. He wanted access to capital for his businesses, for his investments, and for the child's expenses. It gave him the structure to capitalize. It gave him a teaching tool for his son. It funds everything his child needs, from bicycles to braces to college and businesses. Money he was going to spend anyways. Money that otherwise would have been sitting in someone else's bank, making someone he doesn't even know rich. But instead, he chose to create his own, and it gives shape to his son's entire life and will bless his grandchildren and his great-grandchildren yet to come, all because this dad decided to do something that this child couldn't do for himself. He began capitalizing his life when he was too young to even understand it. And this is just one policy. It was never even meant to be just one policy. It's meant to be a system of policies. with multiple lives insured. Nelson calls that diversification of lives insured. It is so powerful. It can seem too good to be true, and we wonder why we haven't heard about it before. Well, that's a good question, but I'll tell you who does know about it. The Rockefellers knew about it. Chase Bank knows about it. They're sitting on at least $10 billion worth of life insurance right now. McDonald's knew about it. JCPenney knew about it. Walt Disney knew about it and started Disney with it. I tell you who doesn't know about it. This 2-week-old baby boy. He has no idea what his daddy has done for him. And yet he has now massively changed the trajectory of his entire life. So let me ask you a question, especially my parents and grandparents. What kind of financial environment are we building for our children? Proverbs 13:22 says a good man leaves an inheritance to his children's children. And the scripture doesn't describe inheritance as some kind of optional luxury available only to unusually successful people. It actually describes it as ordinary behavior of a righteous man who thinks generationally, who thinks after God's own heart, because God himself has left us an inheritance. So congratulations to my client on his new baby boy. And congratulations and kudos to you for getting it. I am so proud to work with people like this, with people who think long range, who think generationally, and care about their families. We have a whole generation growing up, struggling in a debt slave construct, drowning because of inflation, working half the year just to pay taxes, dependent on government programs. And I'm here to tell you it doesn't have to be this way. We can change that through the power of dividend-paying whole life. You have to wrap your head around this concept. Take the time to read a 92-page book. For God's sake, it's not that hard. And embrace it fully as a lifestyle. It is nothing less than a way of life. It is time we circle the wagons in our families. So back to our question. Why in the world would you put whole life insurance on a baby? Why wouldn't you? I hope this has given you a lot to think about, and I hope it gives you hope for the future. If this episode has you thinking differently about your family, about dividend-paying whole life, and about the infinite banking concept, reach out to me at banklessbydesign.com. I would absolutely love to have a conversation with you. We can make an incredible change. And until next time, thank you so much for listening, and have a great rest of your day.
Thanks for tuning in to the Bankless by Design podcast, where we're done with the system and we're doing money differently. Be sure to subscribe, share this episode with someone who needs it, and visit us at banklessbydesign.com to learn how you can start living bankless by design.